Want to start investing in stocks but don't know where to begin? In this video I'll walk you through a simple, step-by-step plan to buy your first shares and build a solid foundation. Stay with me. Welcome to Wealth with Beecroft. This channel explains investing in simple, friendly steps. If you like easy explanations, subscribe. Now, let's get started. First, what are stocks? Stocks are pieces of ownership in a company. When you buy a stock, you own a small slice of that business. Stocks can grow in value over time. Historically, stocks have outpaced savings accounts and inflation. That means money invested in stocks can buy more in the future. But stocks can be volatile. Prices go up and down, sometimes quickly. So stocks are best if you have a longer time horizon. Usually 5 years or more. Why choose stocks? 3 reasons: growth potential, compound returns, and easy access. Remember, growth potential comes with risk. Next, set a clear goal. Ask, why am I investing? Common goals: retirement, buying a home, or long-term wealth building. Timeframe matters. If you need the money in less than 3 years, stocks may be too risky. Short-term needs are better served by cash or short-term bonds. If your goal is 5 years or longer, stocks can be useful. Also decide amount and frequency. Will you invest a lump sum or small amounts regularly? Regular investing is called dollar-cost averaging. It helps reduce timing risk by spreading purchases over time. Now pick an account. Account types vary by country and goal. Retirement accounts may be tax-advantaged. For general investing, use an individual brokerage account. Choose a broker with low fees or commissions. Look for a regulated broker with strong security. Enable two-factor authentication. Check for fractional shares. Fractional shares let you buy parts of expensive stocks. This is very helpful when starting with small amounts. Also look for recurring buy features. Automating purchases makes investing consistent. Next, what can you buy? 3 common choices for beginners: index ETFs, individual stocks, and robo-advisors. Index ETFs: these funds track a broad market index. They give instant diversification and low costs. For most beginners, ETFs are the best starting point. Individual stocks: you buy shares of a single company. This can give higher returns or bigger losses. Keep single stock exposure small as a beginner. Robo-advisors: automated services that build and manage portfolios for you. They cost a fee but are hands-off. How to choose? If you want simplicity and low cost, start with broad market ETFs. If you prefer convenience, consider a robo-advisor. A simple starter portfolio can be 3 parts. First, one broad market ETF, about 70 to 90% of the portfolio. This gives exposure to many companies and sectors. Second, a defensive allocation, bonds or a short-term bond ETF, about 10 to 25%. This reduces volatility and adds stability. Third, an optional small allocation to a single stock or sector, 0 to 10%. Only add this if you understand the company. Example: if you are 25 and comfortable with risk, you might do 90% stocks and 10% bonds. If you are closer to needing the money, lower the stock portion. Rebalance once or twice a year. Rebalancing returns allocations to target percentages. It enforces buying low and selling high. When choosing an ETF, look at 4 things. 1. Expense ratio. This is the annual fee the fund charges. Lower is usually better. 2. Holdings. What does the ETF own? A total market ETF holds thousands of companies. 3. Liquidity and volume. Higher trading volume generally means easier buying and selling. 4. Tracking error. This shows how closely the ETF follows its index. For beginners, choose broad ETFs with low expense ratios and wide holdings. Examples: total market ETFs or S&P 500 ETFs. Avoid frequent trading of ETFs. They are built to be held long-term. Now a practical walkthrough of orders. Market order. Buys or sells immediately at the current market price. It fills quickly but may have small price slippage. Limit order. You set a price to buy or sell. The order fills only if that price is reached. Recurring buys. Set automatic purchases weekly or monthly. This supports dollar cost averaging. When placing your first buy, verify the ticker symbol carefully. Confirm fees and whether fractional shares are available. If fractional shares exist, set the dollar amount rather than the share count. Check for dividend reinvestment options. Auto reinvestment compounds returns over time. Keep security in mind. Use a strong password and two-factor authentication. Beware of phishing and fake apps. Risk is real. Here are simple rules to manage it. Diversify. Don't put all your money into one stock or sector. Keep an emergency fund. 3 to 6 months of expenses in cash prevents forced selling during a market drop. Dollar cost average. Invest regularly instead of trying to time the market. Keep fees low. Fees can eat returns over time. Common beginner mistakes: chasing hot tips or meme stocks. Trying to time the market, buying high and selling low. Overtrading. Ignoring taxes. Stay disciplined. A calm, consistent plan beats quick speculation. Learning matters. Ways to improve: read foundational books, follow reliable channels, and practice with paper trading. Keep a simple journal of trades and decisions. Note why you made each move. Avoid noise. Focus on basic principles. Diversification, low cost, and long-term thinking. Here's a quick checklist to get started. 1. Define your goal and time frame. 2. Save an emergency fund. 3. Choose a low-fee broker. 4. Start with a broad market ETF. 5. Set up recurring buys. 6. Rebalance annually and keep learning. Do these 6 steps and you'll be on a solid path. If this helped, like and subscribe for more simple investing guides. Comment below, what amount will you start with? I read every comment. See you in the next video.